good morning, good afternoon, good evening, or good evening, good afternoon, and good morning. We'll focus on the exam question or exam type question on group cash flows. So we can look at the question. So the question reads, the following draft group financial statements relate to Findlay, a public limited company. Findlay Group statement of financial position as at 31st December 2018 are as follows. This is the income statement. And this is the source, statement of changes in equity. Then we have brief notes. The following information relates to the financial statements of the Findlay Group. On 1st June 2018, Findlay acquired all of the share capital of Kambwili for 52 million kwacha. The fair value of the identifiable net assets and liabilities at the date of acquisition that have been reflected in the year-end balances of the Findlay Group are as follows. So you can see there was an acquisition. Within that, property, inventory, receivables, and cash and payables. Findlay owns 20% of the associate. The associate made a profit for the year of 200 million kwacha and paid a dividend of 175 million. During the year, Findlay charged depreciation of 130 million on its property, plant, and equipment. It sold property, plant, and equipment with a carrying value of 43 million for 50 million kwacha. So we can start stage by stage. We'll start with the working number one. So to be movement in working capital. You have receivables, inventory, and payables. We start with the opening. This is the opening balance. Receivables. So receivables, 400, inventory, 593, payables, 425. I guess there was some acquisition which actually increased The receivables, it's increased the working capital, the receivables, inventory, and payables, as long as there are some acquisition. So, I guess we'll find what we need. Receivables of 13. Inventory. It was of 32. So, meaning that in total, so ideally, this is what is expected. But what did we get? What I would call as actual? That should be the expected closing balance. But what is the actual closing balance? So the actual closing balance will go to 2019 or 2018, sorry. See, receivables of 450. Inventory of this. Payables. That much. So what we're actually saying here, this is where we're going to avoid these movements. So this is what was happening. We expected the closing balance to be 413, but it was 450. This is a cash outflow. Here, we expected to have inventory at 616. It went to 539. There was a cash inflow. Here, we expected trade payables to be at 438. It went to 301, meaning that we paid those cash out. Oh, sorry, that's a cash outflow. Here, I can call it cash flows. Right? This is what it was. So that's working one. That's working one. So then now we go to working two. Let's check what we can compute under working two. Do we have tax? I can see there's some tax here. There's some tax there. There's some tax here. Okay, I guess we can go for tax. Let's go for tax. Sorry, guys. So Yvonne, tax payable. If we are using double entry, we expect the balance brought down. If it's an obligation, it shall be on the credit side. But then we're using the vertical analysis, which is much, much easier. And I always ask my students just to use the vertical analysis than going for the double entry, the tabular one. The tabular one, I think, is much easier to understand. So here, guys, we'll start with the opening balance again. So what was the opening balance for our tax? We go to 2017. We add in form of tax, guys. Here, let me do it nicely. Cut this, bring it here. Oh my God. So we go to deferred tax refund. We pick for 2017. That is what we're going to pick here. Current tax. We'll go to current tax and pick that one. So we have picked, I can put it in. So say pick 2017, so numbers. That is what we did. This is the opening balance. So this is what we expect. This was the opening balance. From here, we actually pick from P and L. Charge. So it's going to increase this obligation because at that time you hadn't paid anything. So pick that. So meaning that this is what you're going to owe the Inland Revenue Authority. You owe the Inland Revenue Authority 716. So I can do this. Pick the number from here. Right. But this is what we are supposed to owe the Inland Revenue Authority. But what have you done to check if there are any movements? You have closing balance. Yeah, I don't know if it's million kwacha or thousands, I don't know. I'll assume that this is what is there. So closing balance, guys. So this is the closing balance. Understand this concept so well. Try to understand it. But then, in between there, you have the payments, tax paid. Or if you receive income from the Inland Revenue Authority, that is going to be regarded as a tax claim. Or tax claim. So here I'll put it like this in brackets if it's a tax claim. No, which one do I put in brackets? Tax paid. Leave a bit of some space. So this is your closing balance, and this was your total, that is your opening plus the P&L, your obligation. That difference, this is what you paid. Any questions before we go to another sector, to another section? Yvonne, be sharp and contribute. Let me know. Is it okay? I guess it's fine. I hope the numbers look okay. Is the tax payable okay? The deferred tax, the opening tax. Okay, that is okay. See hitting there. We just try to verify the numbers, guys. Current tax. Current tax is hitting on trade payables. It's supposed to hit on 35 here. It's supposed to hit on 35. So it shows that there was a tax claim. Yvonne, is it okay? Is it fine? Just look at your numbers. If I made a mistake somewhere, please let me know so that we correct these numbers together. Now we proceed to working 3. Working 3, we can deal on the acquisition of property. Remember that under cash flows, our interest is the cash movement. Only those transactions that provide cash movements, those are the ones that will be taken care of. So we start again. We'll start the opening. Okay. So what is the opening balance? It's 13. Then we check on the acquisition. How much did we acquire? this is what was acquired. How much did we dispose? If there was any disposal of property, plant, and equipment, we'll have to include it. Was there any disposal? Let's just check the question. During the year, Finlay charged depreciation of 30 million kwacha on its property, plant, and equipment. It sold property, plant, and equipment with a carrying amount value of 43 million for 15 million kwacha. So, what is the carrying value? Was 43. So, was 43 minus 43. Okay. Then depreciation. How much was depreciation? I have to go up and check. It must be somewhere. Depreciation during the year was 130 minus 130. So this is what was actually expected. This is what is expected. But what is the closing? Closing balance. It's 18, right? Meaning this is what was actually paid. I'll just show the cash flow like this, dash paid. So you had 18 minus, since we're paying, we can do this, guys. This is what is expected, but at the end of the period, we had 18, meaning we acquired it. This is what was acquired. You understand this, guys? So we got working for which would be on goodwill on acquisition. What was the fair value consideration? So the fair value consideration was 52. This is what we're told here. Findlay acquired all of the share capital of Kambiri. Then what was the net assets? $43. Then we'll go to working 5 to test the impairment. The spelling doesn't look okay. Okay, it's fine. So here we'll look at the opening goodwill, opening balance, which is basically the goodwill. So what's the opening balance? We can decide. Then additions. At acquisition. So we had that 9. So we expect the goodwill to increase to this value, 1319. But then it shows that we had a closing balance of 122, meaning there was an impairment of Zinga of how much? There was an impairment of 94. Any questions up to there, Yvonne? Team? So we go to working 6. So on working 6, guys, we'll do it the associates. So on the associates, as usual, we have to start with the opening balance. When we check, it's under the investments, which is that. Then additions from the P&L. That total, it gives you this. This is what you expect. But what are we told? What's the closing balance? The closing balance, guys, we come there and pick the closing balance. Right there. So what was received? This is basically cash. This is your investment. So this is what you received. If what went back into the to the books was 190 when supposed to be 200, it means that you received some cash as evidence your returns from associates, which is 10. We are done with the first part of this question, just doing the computations. Then now we can try and come up with a cash flow statement. What should guide us is that whatever we're going to do, this is the amount that we should find. This. That is what we should find. And the changes in cash and cash equivalents, it should be this minus that, 68. So we now look at the statement of financial position, statement of cash flows. Let's just check on the income statement so that we get a guide of what should be there and what should not be there. So start with the group profit. For tax, we add finance costs because they have their own space. In short, we are subtracting them. We are removing them from the picture. What else? Okay, even if I don't put the add, what, basically you'll be able to see the polarity of these numbers. Depreciation, this is a non-cash item. We have depreciation somewhere, and that's depreciation. Impairment. Was there any profit or loss on disposal? Let me just check on the question. During the year, Finlay charged the person on his property plant, sold property plant and carrying value of 43 million for 15 million, meaning those a profit on disposal. There was a profit on disposal, which we have to subtract of 7. Because 50 minus 43. Because the carrying amount was 43 and this particular property was sold at 50. So there was a profit on disposal of this, which has to be a negative. There was a loss, we're going to add it back. It's a non-cash item, so we're removing this. What other thing do we have? So we have whose share of associates profit share of associates profits sorry it's this side. This, because it's a profit, we have to remove it. It has its only portion under investments where we're going to have it. Then we go now to receivables, inventory, and payables. Where's inventories? This was a cash outflow. Inventory, it was a cash inflow, and payables, we had a cash outflow. So so this is where now we're going to have the finance costs and tax paid. We can call it interest paid and tax paid. Yes, we had something on interest paid. We didn't have. Let me just check on the question. If in the balance sheet is not there, then it is assumed that that which was charged in the income statement, that is what was paid. We are able to see the finance costs in here, but are we able to see it in the balance sheet and the current liabilities? No, we are not able to see it. So it means it was paid. Mwamva, Yvonne. So we'll pick it from here. No big hassle, but it has to be negative now. Tax paid. So there was a claim, which is an addition. So I'll say net operating cash flows. Any questions up to here? We now go to investing, then we'll go to, after investing, then we'll go to financing. So on the investing, guys, we'll start with property, plant and equipment. I'll just type PPE. We invested in PPE. How much? 658. There was also the disposal. Remember the disposal PPE. At this point, we're only looking at cash movement, which was 50. I can show you here, Yvonne. This is where it is. Yeah. Yes. Mm-hmm. What other investment was done? Associates. Mm-hmm. Associates. How much did it receive? Which is basically it's some dividend. Okay. Okay, so on the associates, this is just the dividends that the parent company is going to receive from the associate. Then also the acquisition. Acquisition of the subsidiary. So the acquisition of the subsidiary, guys, will come here. So listen and listen very carefully. It shows that how much was spent, 52 million. That was the cash that was spent, Yvonne. But when they were checking the drawers as they were acquiring the company or in the bank account, there was a 5 million. So we have to reduce that 5 million from the 52 million common, that's all capital. So here it will be 52 minus 5, which was the cash. Since this is acquisition, we expect it to be in negatives. Mm-hmm. It's not looking right. Mm-hmm. So then now we go to financing activities. Mm-hmm. So under financing activities, what finances this business? Always what finances the business is this component from here. From here. This finances the business. Maybe minus the Fed tax because we took care of it. So this. So on share capital, so any increase of any movements that actually increases transactions below, just under equity going down, regard them as cash inflows. So here, there was an increase, meaning that we could have shares, they could have sold shares and ignore retained earnings. It has already been taken care of under the income under operating activities, and because it's basically a product of non-cash flows. Some certain items are non-cash items like depreciation. So always ignore it because it has been taken care of by Budget on top. So just ignore it. So we ignore the first. This one is ignored, never included. We go to the NCI. NCI funded. I hope they did. Yeah. Then we go to debt. This is interest-bearing debt. Got to cut and bring it here. Remember what we're supposed to find. I must have written it somewhere here. Or did I delete? Is it a 28 or so? We must find a 68 in terms of increase or decrease in cash. Cash and cash equivalents, you can go on and write. It shows that there's one thing that hasn't been taken care of. And what is that thing? Why is it not balancing when it's supposed to be 68? There's one thing here, guys. We included a transaction that has nothing to do with our funds. These are externals, the NCI. We don't get any cash from them. There's no cash movement. So the issue here is, did we give them dividends? That is the only thing that we should see. Did we also give ourselves dividends? Did we pay dividends to our shareholders? So when we come this side, we check on the statement of changes in equity. It shows that there were some dividends that were actually paid, to the shareholders of the parent company and also to the NCI. That's it. So in here, we have dividends that was paid there. We also have, these are NCI dividends. Then dividends to ordinary to equity shareholders. To equity holders. Which is this, comma. Then we bring in the closing, the opening balance. The opening balance, 2017, which is 294. So it should be able to give us closing balance. such that if we do like this equals to the cash balance in 2018, it should be able to balance. Comma. So any questions? I'll send a question on the forum and I expect you to look at it fully. So thank you so much. Our next topic is IS 36 on impairments. So please start looking at it. Tomorrow I'll be looking at IS 36. Today you have to make sure that you look at the exercise I'm going to give you, work it out and send it to me. Bye-bye and thank you so much.